thank you for making it, and thank you to the panelists. I'm going to start left to right and just basically make some basic introductions, starting with Cromwell Coulson. And Cromwell is head of over-the-counter markets group. He's their president and chief executive officer and a director, and he actually led a group of investors a number of years ago in acquiring the predecessor business, which some of you may recall was the National Quotation Bureau, and then led a transformation of what was an incredibly opaque and inefficient market into much more of a technology-driven, open quote system, transparent, connected marketplace. They have connectivity into all the major broker-dealers in the United States, and it's now one of the world's largest electronic marketplaces in which brokers trade over-the-counter securities. And they have gone through a sort of a transformation, if they will, of creating different tiers in the market that are information tiers so that companies can distinguish themselves. And I know that they range from OTC QX, OTC QB, and OTC Pink, which I think is a successor, if you will, OTC Pink to the old Pink Sheets. Is that correct,
Yes.
Cromwell? And so he has got a lot of knowledge in how over-the-counter stocks trade, how they attract liquidity, and I'm delighted to have Cromwell participate. And second, Karin McKinnell. And Karin and I had the fortune of working together at NASDAQ for a while, many moons ago now. She's been there for 14 years and serving as actually the designated relationship manager to about 500 public companies at one point, handling business development on the West Coast. She came to New York at one point and oversaw a range of businesses, including the what was the name of the research exchange? The Independent Research Network, yep. Was it? And been a key member of the corporate client group and serving 40% of the top 25 NASDAQ issuers. And so at one point, she actually was the primary relationship person for Microsoft, Intel, Dell, Oracle, eBay, and Google. So that in and of itself, I think, probably created some interesting stories. Working with a wide variety of venture capitalists. I know even folks like pretty tight with, I know you know John Dora, Kleiner Perkins, Caulfield Byers, for example. Ran the IPO team, launched the private company practice group and equity capital markets, spearheading the outreach to the venture capital community. And she also ran the Portal Alliance, which was an endeavor designed to trade 144A securities in conjunction with 9 bulge bracket firms. And then also has turned around the NASDAQ Reuters joint venture, the Independent Research Network. I think we just mentioned that. Before NASDAQ, actually worked at Goldman Sachs, Franklin Templeton Funds, Portola Group. So, and then Karin, what are your core responsibilities now? Is it the listed market, the IPO market?
It's still on the listed and business development side.
Business development, terrific. And then David Studinsky. David wears a couple of hats at Piper Jaffray. He's based here in New York. Firm's headquartered in Minneapolis, and he is their head of healthcare investment banking. So absolutely,
capital markets, yeah.
Healthcare capital markets. And he's got the vertical, but he also is their expert in alternative equity transactions. So all the kind of the creative, funky things, the new things that come out, and this includes from all the equity-linked financings, from IPOs, follow-ons, underwritten registered directs, private investment in public equity or PIPEs transactions. So, and anything that's kind of emerging in this sector, he's going to be on the edge of the wedge trying to figure out how to better apply it. So I think part of the conversation we're going to have is what are we starting to see in the wake of the Jobs Act? What are people starting to try and do? What is the application, for instance, of testing the waters provisions going to be? Maybe we just start right there. You got an MBA, but before I do, MBA from from Stern here in New York, and a Bachelor of Science from the University of Delaware. So let's start with that. You know, where people are tracking to go public today, right? And there's a big change in discussion. We got confidential filings, which were not an option to issuers. How much of that how much of the IPO market is shifting into the confidential filing phase? What are the implications of that to the market? And then secondarily, how do you think the testing the waters provision is likely to be used?
Yeah, well, thank you for that, David. Can everyone hear me okay? No, this mic's on. It's a little low. No, we'll just check the mic. Is that better? I'll try to speak up. So I think David hits on probably the two key portions that we see in practice most frequently now. One is a company's ability to file confidentially. That's a new application for a company considering going public, filing an S1 for the first time. And then the second component, referred to as testing the waters, or otherwise going out and conducting marketing meetings with prospective investors. Previously, that was a very tough ask for many counsels to get comfortable with a registration statement on file for fear that there would be discussion outside of prospectus. And the third part of what you asked there, David, I think is, you know, how much have we seen that adopted so far? How many companies are utilizing, if you will, a confidential filing process? The short answer is, at least the clients we talk to, most, if not all, are availing themselves now to being able to file confidentially. But with that, you also don't know what the street is doing because of the nature now being confidential. You can't see the backlog like you once were able to. So I think it'll take a couple of months or perhaps quarters to see how many companies come public in that period of time that were utilizing the confidential process. We at Piper at one point did go back and look retrospectively back to 2010, given the parameters for which an emerging growth company can in fact utilize this confidential filing. If you look back to roughly the 284 or 5 companies since 2010 that would have been eligible, we think roughly 87% of those companies that went public, roughly 85 to 87% would have been able to file confidentially. So from my perspective, I'm not sure why a company wouldn't take advantage of the confidential filing. I think it makes a tremendous amount of sense. And as far as
what are the advantages to an issuer? I mean, is it just not allowing your competitors to see, get an earlier peek at? Is it the risk of restatements?
Yeah, it's not so much restatements, because what happens is, even though you file confidentially, when you go through this series of comments and revisions to the S1, at the end of the process, when you have to have that 20-day period before you can effectively go public, so that information is now in the public domain, all of those edits true up. So one can look back and see either updates to risk factors or otherwise. But many companies are doing it now because the market is so volatile. When you're trying to pick a time to go public, rather than be on file, for example, become ready, and then have to wait perhaps much longer than you otherwise thought you would, there's benefit to being on file confidentially, for example.
And so the process of all of a sudden coming out of the confidential filing process, what is that process? I mean, when do you actually, is there a point at which you're committed, or the SEC forces you to disclose?
It's not an SEC force, it's a voluntary election by a company to decide this is the point that we're now going to make the S1 known publicly, and then there's a 20-day period effectively before a roadshow can commence.
Okay.
So if you look at the demands of private companies, a lot of them, there's no question the risk of putting yourself out there and having your competitors know the secret sauce is certainly a big part of the confidentiality element. We have seen some really interesting things. So right now we've got about 204 companies on file. We know of, or at least we're hearing that there's 50 companies out there right now confidentially filed. But we're seeing some very interesting things, which is they may confidentially file, but then they put out a press release that they've confidentially filed. So I think where you will see it's interesting. I think where you will see a filing that has
it's called
option,
a tease.
Yeah, exactly. Where you will see it is in the circumstance in which you actually want a dual track. So if you are actually putting yourself up for sale, which you are with an S1 on file, but if you actually make it public, you're actually both putting it out there to the street saying, I would entertain being acquired, while at the same time preparing to go through the IPO process. So I think it's interesting now how the messaging is around that, because it actually could be an indication that someone would prefer to be acquired than go through the IPO. So how it's being treated, I think, has still yet to come. Generally speaking, for the clients, the private companies that I work with, I tell them to start engaging Wall Street easily 2 years ahead of time, getting to know who the key investors are, telling their story, evidencing that they can actually execute against plan, so that they already have an established track record and they're somewhat more established. Now, obviously, when you get to the point of an S1, historically, before the Jobs Act, there probably were a lot of executives that should have said, oh, I really should have done that before now, and now I'm locked up. So it's giving companies the ability to actually sort of in go mode, establish themselves. But I'm a little bit, personally, I'm a little bit of a contrarian on the concept of the Jobs Act and what we're seeing out there. I talked about the fact that there's 204, I think it's about 204 IPOs on file. I work with the venture and private equity community, and just off the top of my head, I can probably come up with another 40 or 50 names. And then, there's what we hear is 50 confidential. If we're at a run rate of about 100 to 120 IPOs a year, we've got a backlog of 2, maybe 3 years. We actually don't have a supply problem. We have a demand problem. So getting these companies to the point of IPO, you still have to go public. You still have to cross that line. And I think the ability now to go test the waters and to see whether or not you will be recognized and a possible IPO candidate is a really healthy exercise. I think if you looked at like 5 or 10, maybe I'm like 10 now. Sorry, I'm showing my age. Maybe 10 years ago, if you went through the process, and you know this, David, from your history, if you went through the process of doing an IPO and you didn't make it, you pulled your S1, if you did an RW, within 3 years, 80% of those companies went under. So it was literally a go, no go. Now we've morphed into something where you can file an S1, pull it, come back 2 or 3 years later, pull it, come back. So it's not as black and white as it used to be. But I think what we're needing to see is an increased demand for the different types of investors. And so I know there's a number of things in play to be able to address that also.
We could talk about that for a long time.
Yeah.
I agree with that comment.
Well, I mean, let's just switch it over, because I philosophically, I think that I have a view that a lot of demand is created, and we've done a lot of work in terms of looking at the investor base, and the investor base is still there. It's just much more fragmented, and it's largely not cost effectively reached by the street, in our view. And so, when you're trying to get critical mass numbers of shares placed, you got to talk to critical mass numbers of investors. And when most of your return, particularly if you're a bulge bracket firm, maybe on the prime brokerage lending side, you may not be talking to all the right people. So I want to, we talked, and I was seeing Cromwell a couple weeks ago, and in his office downtown, and what is the future of aftermarket support in particular? How are companies finding it, and what needs to change?
I look at the Jobs Act as you have to go back to like what's the fundamental piece, and it's actually one of the largest changes to the securities laws, because the religion before was the only way you can communicate to investors is through a registration statement, and it's a very public process as it goes through. And remember, Google's founders got in trouble for doing a Playboy interview, and there were no communication channels. And what they've really done is opened up communication channels, the ability to talk, the ability for, the thing that scares every bank that has an existing franchise is research, but the ability to editorialize, the ability to add information, the ability to start making connections before you go public. And the market is going to become much more efficient. And the market accessibility through all these channels, because it used to be there wasn't the internet. There wasn't, you could, it was either you did a radio show, a newspaper ad, so the SEC could keep it in this one channel, but it's opened it up and on the communication side, and it's also created this new optionality in different financings, because many companies are going to start talking to investors and they're going to say, oh, well, let's just do a Reg D. Let's do a crowdfunding round for our engaged customers. Let's do these other pieces of it. Let's do a Reg A or a 144A. And there's so many more options as people communicate, and there's going to be a price difference, because if you can do a Reg D immediately with investors, and then you go register those shares, is many companies will say, hey, I'll take a 20% discount to what I thought I would do if I can raise 2/3 of the money I need, and it's instant. And that's really going to, it's going to on-ramp capital, and it's going to increase communication. So it's a big game changer. And I don't think everybody understands the effects, because a lot of these pieces, like general solicitation, Reg A, haven't taken place. A lot of the other pieces, an investment bank with an established business has a very regulated business practice. They're not going to change it tomorrow, is to go towards the edge. They know exactly where it is.
In fact, you're seeing that now, where most of the banks, ourselves included, for the ability to write research almost instantaneously now, almost no one has gone to that model. Very few have. We will, I think, over time.
There will be some non-bulge bracket who has
that,
good research, and they'll start doing it, and you'll suddenly get some contrarian views of research out there. And then suddenly the bulge bracket banks, the number of times in trading businesses I've walked into a firm and say, we don't do that, we don't trade these securities, we don't. And then eventually, once their customers are asking for it or their competitors are doing it, it all starts to move along, and the compliance team has figured out a process where it can be done in a manageable way. And that's like the Jobs Act is a fundamental change to securities law. And it's a huge game changer. And you're going to see more transparency of a company's capital, their whole time in the capital markets. And it's not going to be this giant gulf between listed and private. And there's going to be different financings, different pieces. And I think it really recognizes is being on an exchange is a hugely valuable experience if you're a company that's big enough to be owned by the index funds. And the whole exchange listing process is designed to protect those passive investors. But for other companies, the cost-value quotient has gotten out of whack, so the private market's created all these different sides. And the financing is going to be there. It's going to be really interesting to see where we are in 5 years for the Jobs Act.
And to that point, one of the things, if you look at Wall Street as a whole, you can't just take one piece out, fix it, tweak it, and put it back in. Like, everything is sort of connected with one another. And I think one very interesting piece that probably doesn't get enough airtime in situations like this is how the Jobs Act actually requires the SEC to go in and actually study decimalization. And when you look at sort of the history of used to having small investment banks bringing what I would refer to a smaller deal, and then larger banks taking on larger deals, having so many of our small to mid-cap investment banks go away, how are we being able to address that marketplace? So I think there's no question what we're seeing here is an opening, whether it's research to be able to get visibility into these companies, whether it's the ability to be able to do a Reg A offering. What we're seeing on the 144A side is when there isn't a good IPO market, when it's not open and rich, full force, it's actually really hard to get 144A deals done. So I guess I'd sort of turn to you and ask, like, how are you seeing Reg A offerings? What's out there?
We don't do much in Reg A, but I think that leads to about liquidity.
Nobody does any
right?
yet.
I mean,
So.
when you think about aftermarket support and sponsorship and what it takes, and you talked about maybe widening trading increments, decimalization, nobody on the street really makes money in the cash equities trading business anymore in the small cap space. Why? It's the cost of a long distance phone call. It's pretty much free. Used to be quarters, used to be ACE, used to be 6 cents. Now the electronic networks, half a penny a share. You can't trade enough volume in small cap at half a penny a share to make a return. Some banks have exited the market. It's much harder to do that. So when you think about sponsorship, what helps is liquidity. Liquidity is your friend for a newly public company. There are many examples of companies that go public, and then you're a ticker symbol for 6 or 12 months until you can generate enough sponsorship in the marketplace, and that feeds on itself. Every fund manager learned the lesson after the 08, 09, 10 period where no matter how good the fundamental thesis was of an investment, if your boss came to you tomorrow and said if you had to sell the position, how would you do it? If you couldn't defend that, you wouldn't get approval to buy the position. So liquidity is an important component to helping to restore what's going to reopen, if you will, in a robust, healthy way, the IPO market. And I think part of what we're talking about here will help with that.
Now, I don't want to put you in a bad spot, David, but I'm going on a little bit. But I'm first going to preface it by saying that Piper.
I thought this was a panel-friendly conversation.
Piper does a better job than just about anybody out there making commitments to companies in the aftermarket, clients, in terms of providing aftermarket support. That said, okay, the extent we had this conversation, once before, which is how much time, you look at this, because every day that you're actually providing aftermarket support to an investment banking client is a day that you are losing money. And this is not a profitable proposition, right?
Not in a cash equity trading business, typically. Yeah. But not initially.
And so, you hear it, and I think this is incredibly important, because if a sell-side for Wall Street firm that everybody wants support from is losing money, how much active investment are they going to make in creating liquidity for small and micro-cap companies? Because the more you do it, the more money you lose. And last I looked, nobody was in the business to lose money. So you were going to say something, Bravo.
I see a little different viewpoint, because on our platform, we keep the more automated broker-dealers that provide liquidity and execution services, the Knights, the UBSs, the Citadels, the Citigroup's automated trading desk, keep picking up securities. And they keep expanding their process, and they've really developed a skill of specialization. And last November, Citadel came in and picked up 5,000 securities on our platform. They trade them electronically. But they're not in the position of supporting a price. They're in the position of finding the right price. And that's a business. I think our real issue here is not the trading, the pricing, because we've got firms that are very much specialized, and that's what takes place from technology, it is the selling and supporting the corporate broking. And that's a business model which is hard to support of a stock that trades 20,000 shares a day, 100,000 shares a day. We've tried to develop with our top marketplace, OTCQX, a DAD program, which is investment banks or securities attorneys, and the securities attorneys are doing a passive quality control role, while the investment banks have the ability to actively sponsor and take a company to investors. And that becomes like the corporate broker role you see in England. And I think that's a really important part, because it's not per se market making is really, really improved in my space. And since it's the same market makers who are on NASDAQ, they're able to trade things for much less cost to investors with tighter spreads, with higher velocity and efficiency. The corporate broking, the outreach, the traditional, because stocks need to be sold, and that's part which is I think is the broken part.
Well, that's exactly. Well, we talk about the liquidity package being three things. It's trade execution is the smallest part of it, right? And there's plenty of automated trade execution, as you point out. One is people having an incentive when there's a big buyer and no seller, a big seller, no buyer, for somebody to get on the phone and find the other side of the trade. No money in that business any longer to provide liquidity, and no mechanism to protect yourself by committing capital. And so those three things. By the way, corporate broking market in the UK and the AIM market, and I've been over there, I don't think it works that well. I mean, what happens is there were a lot of cross subsidies historically, and they've taken the top end of the book, which was in a SEAC, old NASDAQ style market structure, okay? And what they've done in the AIM market is they've actually promoted the more liquid stocks, because it's more profitable, the London Stock Exchange, into the electronic market. And so they've skimmed the cream off the top, which put pressure on a lot of the native AIM market makers in London. And so There's a lot of complaints in that market too about liquidity, and again, if you look at it, it comes back to the same thing, which is not enough economic incentive for people to get on the phone to make a sales call, and not enough incentive to provide, research to provide a context or a pretext for a salesman to make a phone call.
And there are always markets within markets, right? So we're referring to the corporate broking market. I think most folks know most of the European exchanges have the preemptive rights, which is why you see so many rights offerings, not regular way offerings. So the economics associated with that in a corporate broking model are a bit different than they would apply here in the U.S.
But we're also seeing some trends in that direction. I know NASDAQ has proposed the Market Quality Program, or the MQP, and what we're trying to do is actually create an incentive for those parties that actually improve trade or overall liquidity performance in an ETF. And that's in proposal mode now, and we're also seeing the Patrick McHenry going out there and actually having that same concept is, can you have a small cap company actually subsidize, can you put money on the table to be able to actually pay someone that's going to be on the inside driving liquidity in an aftermarket? So can you introduce more economics into the equation?
Payment for market making,
right.
But I mean, I'm all for giving issuers more options, but I think that the question is, should the cost of that be borne by the issuer, or should it be borne by the market to create visibility? In other words, is that model really, is that really going to work well when you're a small company? Think about a biotech company. It doesn't have a lot of cash to begin with, needs to conserve its cash to invest. And are they, how comfortable and how much money you're going to have to pay to make a difference on your market making? And will that model at the end of the day really create the sales incentive where it's not just people positioning securities, people getting on the phone to market it? Will it do the heavy lifting that you want it to do at reasonable cost to the issuer? And so I wouldn't stand in the way of giving issuers an incremental option and giving the marketplace, but I would say that it's not clear to me that model has worked that effectively in the UK, and it's not clear that it would work that effectively here. It helps on the margin for some issuers.
But that, I think that's the Jobs Act is getting, and the whole idea is let's try a bunch of things. Let's see what can work to start bringing liquidity and transparency. And every issuer, every company I ever meet, they don't have, they should have better respect and better ownership by investors. And, the aim, when you do an IPO on the AIM, it's to, 25, 50 investors. You're not going to trade that much then. So you have to set your expectations. For that part, as an interim step between, it's fine. And it is creating liquidity. It is having, let's go back to the fundamental value of what a marketplace does for equity or securities in general. It liquefies it. It creates wealth. It creates a balance sheet, a wealth statement. And that's the important part is, and it also has a place where investors' opinions, by buying and selling it, can say, how is the company doing right now? And we do have markets that the AIM created for companies that are sub-NASDAQ, in many ways, and some of them, a good proportion fails, but it became a transparent market. And it's much better to have something trade in an AIM style, which is transparent. There's adult supervision of a nomad in the AIM, rather than kind of how, pre-Jobs Act is how the Facebooks and Twitters would trade, where as a broker, you can't show a price in Facebook shares pre-Jobs Act because that was considered soliciting things. So by the fundamental view of securities laws was, if it's not a registered security, there should be no information available. This stuff should take place in dark rooms. And the Jobs Act is changing a big chunk of that. Yeah. And that's going to make capital markets across the spectrum more inclusive, more informed, and more efficient.
It's interesting. The NASDAQ was very supportive and very active of the Jobs Act. So when I talked about the demand situation, it wasn't because we don't want more supply. We certainly want a larger IPO market. But I think there was just sort of a number of variables, and the amount of risk and cost associated with going through the process has been addressed in what we have with the Jobs Act here. And there's no question we have fantastic companies that are on file looking to go. We have great companies that are behind them. So we certainly have a strong pipeline of what we're seeing out there. And with 50 companies, potentially 50 companies on file confidentially under the Jobs Act, this is opening doors. And I think for the ability for a company to be able to leverage the relationships of research, of bankers, of being able to solicit early, and going through the exercise of doing, whether it's a mini IPO with Reg A, the amount of flexibility that a private company has today is far greater than it was before. And there's no question, the bar has gotten higher and it's been harder to go public. So being able to reduce some of those mandates certainly makes it easier for these companies. But there's also the other side of it, which is research being out there supporting the names for investors to understand, for banks or firms. I imagine there's going to be a lot more companies coming to market to try to help these private companies actually go out and meet with investors, doing larger rounds or doing rounds outside of the public markets. And we certainly have seen that with the second markets and the shares posts of the world. That's not going away. And if you look at the super angels that are out there putting money to work, there's no question that private companies are going to be private longer. And so where can we make that blended space a little bit better where they can actually go public sooner, or there's more options available to them as private companies?
Equity is worth more to your investors if it's tradable. And if it's priced, if it's valued. Can they value it? Can they trade it? And to get to valuing and trading it, you need to be able to analyze the company.
I mean, we had a series of slides earlier, which you didn't see last night. But I mean, we have data that shows IPO success rates have been in secular decline for 18 years in terms. So no matter how you cut it, and about 60% of IPOs now are breaking IPO price by the 30th day of trading. And so people look at it, and there's a tendency to say, oh, the window's open, the window's closed. But really, if you look at it over the long term, there's been a steady degradation in those successes, and that may be due to the fact that if you go back and you look at how Wall Street was structured over that 15-year period, we had armies of retail brokers that knocked on doors that supported stocks in the aftermarket because there was a heavy incentive to remarket the shares in the aftermarket. We had almost every bulge bracket firm, major bracket firm, had a middle market institutional sales department. There were plenty of smaller, tiny institutional accounts that were covered by retail. And so that the quality and the breadth of the distribution, because you mentioned demand, and I would argue, Karin, that a lot of demand was created, right? And so that the demand creation mechanism of the market may not be quite what it was because we can't keep the armies of brokers employed that we once did. I want to shift gears here for a second. And I want to ask you, okay, you've got very different sets of experience, and I want to come right down the row and say, if there was one best practice as an already public company that you would implement to be successful in terms of attracting the right kinds of investors, versus the conventional wisdom, what would you do? Starting with David.
Already existing public companies, and I take that to mean smaller cap, not yet defined, not yet well-developed shareholder bases. We actually find ourselves in that situation with clients quite often, and it's kind of a part A, B, C here perhaps, but you'll never fix it with just one transaction or one point in time. If you buy into a series of steps over time, those tend to be very good case studies. And what I mean by that is, and when I talk about delivering the firm on the trading side, on the research side, on the non-deal roadshow sponsored side, on the banking side, on the capital market side, that's what it takes. And it takes usually over a period of years, not measured in months, not measured in quarters, to go from having 5, sometimes 6, sometimes 8 or 10 real bona fide institutional investors to having a 3, 4, 5, 6-page Bloomberg list, if you will, as you scroll through the shareholder list, getting some more stock in the flow and increasing sponsorship in the marketplace. If you think there's a quick fix, I don't think there is. If you buy into it, run your company, focus on the fundamentals, and then work at communication into the market over time, that we've found is a recipe for success.
Karin?
Yeah, so this, from an NASDAQ perspective, this is actually an interesting story, where historically it used to be Wall Street was all about how good of a storyteller are you, how credible are you, and do you execute on what you talk about. And as long as you did that consistently, you were golden in terms of sponsorship, and the banks were willing to take you out there because you were predictable. Fast forward through a number of different changes, whether it was regulation around research, decimalization, any of the various changes, the burden is now falling on the shoulders of the management team to go out there and actually more shoe leather, more time in front of the street, and not necessarily leveraging the research community because you may or may not be available to you. So the burden really falls on the management team. And old school, who owns me versus, who owns my peers versus who owns me direct targeting is an interesting approach, but the reality is you have no idea whether or not those investors are actually increasing their position, dealing with net redemptions or new money coming in, or there's a number of different variables. So, and forgive me for sounding like I'm putting in a plug here, but you did ask the question. So NASDAQ actually has products and services that speak to this directly, where we have IR targeting that identifies good long-term investors. So it's not just who can you get in front of to be able to buy the stock, who do you think is going to buy the stock. We actually have tools that specifically identify key long-term shareholders or potential long-term shareholders, even based on their behavior around have they participated in your earnings call, are they spending time signing up for press releases, are they dealing with, are they buying the sector right now? So there's a number of things that we look at specific to them, specific to their buying patterns, to be able to give specific information as to who would be a good long-term investor. And a big part of that, or the kicker to all of that, is the burden today for the management team. They're spending 30 to 40% of their time dealing with Wall Street, which is a lot of time not growing their own business. So our intention is to be able to be much more efficient in identifying the right types of investors to get in front of, but the burden absolutely falls on the shoulders of the management team.
So,
Cromwell?
I mean, I'd take it as we did an experiment in our own stock, which was we were a private company and all our employees own stock. I own a big chunk of it. And we've had outside investors when we bought it. And we converted to have our shares, got a transfer agent and deposited them at DTC and had a broker sponsor us to be traded on our marketplace. And it's been an interesting experience for us on our platform because in many ways we don't have a lot of problems of companies trying to raise capital because we're profitable and we have no debt and cash and pay a dividend. But we look at our liquidity, and it is what group of investors you want to be talking to now, building your track record, growing. We went from a small auditor to Deloitte. And as you execute, it's a long process as you build a track record. Because there's one part is, I've listed on NASDAQ, I've listed on NYSE, I've gotten into this club, everything is great. In truth, it's not a guarantee. Investors know it. You have to build a track record.
It's a hunting
Warren,
license.
Warren Buffett buys a series of cash flows over years. And this is what you're really trying to build into. And you're targeting the right group of investors. And what you want to do is have enough interest that if one of your investors needs to sell, there's buyers. And there's enough mix of, and like our stock trades, that whenever a block shows up, there's 4 or 5 different institutions that are bidding on it. And that's enough. We don't really need a lot of liquidity. Other companies are obsessing all the time because they're trying to raise capital. They all think they should be able to raise capital at a huge premium, when in reality, you get a premium when you've delivered a long term of execution. And that, those are the great companies. So, I mean, I look at it in building your marketplace, you have to under promise and execute and deliver over time. And that is, and companies we see, what we've seen on especially our top tier is, on average, management and directors own 30% of the equity of the companies, the US companies on OTCQX. And they're generally, the investors are tag-along investors, but they're executing. And investors they see that management has skin in the game, and that over time, they'll hopefully build value. And that's the part of what, as you build your support to investors, is you're building a track record, and you're upping your game, you're improving each year, and small companies get a chance to grow their way through, because at a value, a market is just showing what people think the value is today.
I mean, there's some pretty fair consistency, I think, here. I mean, it takes a lot of hard work. I would say there's a 3-touch rule with institutional investors. Most investors don't invest until you've touched them several times, and so that has grave implications for what people are doing in an IPO, which is, if that's the first time. This is why the testing the waters provision is so important, particularly for technologically complicated stories, the biotechnology industry, which is, you get out there, you develop a relationship with the investor, and they develop some confidence in you, and you're going to have an ability to effectively pre-price transactions and take a lot of the risk out. That hard work of creating demand, in some respects, is going to be shifted to the management team, doing the work prior to the roadshow. But it's very, very consistent. Corollary to this is, okay, if I gave you one thing that you could change in market structure, okay, to fix capital formation and the aftermarket support make it better, what would you do? Your Congress and the SEC all wrapped in one.
Only one?
What's top of your list?
So I think there's 1A and B again. 1A is you have to put some spread back into the market making, especially to create the incentive for more folks to make markets. Whether you're NASDAQ listed, over-the-counter listed, it doesn't matter. When you're small cap, I said it before, you don't trade enough. It's hard to get that real sponsorship from the street. The other thing I think that's still an impediment is the lack of an ability to communicate effectively with your research analyst, given the whole Spitzer settlement process. I will tell you, it's still very foreign for companies, to borrow your term before, really have to shoulder the load on the communication thread with the research analysts, because of the Chinese walls that exist, and they do exist, and they're very high, about an ability to communicate, even with my own colleagues and employees who happen to sit in a research department. There's a vetted process, there's a way to get information, but it's very inefficient and direct line of sight communication, very specific thoughts that are very critical when forming points of view, storytelling for a specific company. So that's my 1A and B.
And any discussion in-house at Piper about that new category of emerging growth companies, and technically you're allowed? I think a lot of those separation between church and state or research and banking rules are sort of abrogated in the context of an EGC?
There's a little bit. So one portion of that is an analyst is now allowed to meet in the same room with a banker and for an EGC as it relates to some IPO vetting. But it's going to take an adoption cycle over time, both on that front, on even some of the one other observation, talking about aftermarket support. The next thing I think you'll see adopted around the street will be this, this embargo period that exists around lockups, for example, now with even writing research, where there's a 15-day blackout period. I think that's going to go away. And then I think you'll see, as I mentioned very early on in my comments, the time when analysts write research on companies. It used to be 40 days mandated. It's come down to around 25 or so now. I could see that going to a 3-day or something period, but that's going to take time as well.
Karen?
So my first reaction is tax reform for investors buying into IPOs, where it actually incentivizes them to actually hold it for a longer period of time, so that there is another layer of efficiency put into the marketplace, or economics, right? I think what we're dealing with here is we have an economics problem with trading, with research, with how do you pay for all of this. So my first response, and partly is because I am somewhat focused on the demand side of the equation, but I really think it's an overarching issue of the economics aren't quite aligned with what everybody needs to do in order to get it done. So I'll stick with what my answer is, but I sort of I'm agreeing with what David
You're
talked
agreeing
about.
with David.
Yeah.
So we got tax incentives, we have let the research analysts work with banking again, and we have increased spreads or tick sizes. Right? So far, Cromwell?
I would say, the big piece is transparency, and is that we should regulate our markets with transparency, and that should be our overriding goal of having more information out there. And there's a lot of points where information in the Jobs Act has opened this up, but Karen's point where she said, oh, if you publish your secret sauce in your S1, all your competitors will crush you. I would say as an investor viewpoint, if a company's secret sauce, that it only works if nobody knows about it, it's probably not a great franchise. It's a little bit of a short term, it's a little Groupon-like. So if we get more transparency, there's a market that's actually a lot like Second Markets and SharesPost in Sweden, run by the ex-head of the Swedish Stock Exchange. And those companies, they all publish their annual reports on their websites. And if you want to build transparency and trust with investors over time, put your disclosure out there when you're pre-IPO. Start letting it, let people build a track record, see how you see things. It is the secret, information availability builds trust. And there's a lot of parts where we try and regulate an activity by stopping it rather than making it transparent. I mean, it's like, let's not have congressmen be able to buy and sell stocks. I can tell you, when I go visit a congressman, the ones that buy and sell stocks are the best ones to talk to about market structure because they understand how it looks, how it works. They think like investors. They think as oh, this is bad for companies. This is good for companies. This is bad for creating jobs. But we should make it transparent every year. What did that congressman buy and sell? And then if they do something that their voters don't like, it becomes pretty clear. And a lot of, we keep having the regulatory world comes to, let's stop this bad activity. There was this one part that was bad. Let's make it transparent and let's let the market decide for itself. And that's, and that's what I think why I am so incredibly, optimistic about the Jobs Act. And as I talk to the people in the House who are the architects of it, this is just the beginning. They want to blow away to make information availability out there. They want to, use the internet and make marketplaces have information. And that's going to be really important. And that is like transparency is good. Yeah. People will still make stupid mistakes. Markets are wrong, investors are wrong. But if the information is out there, I was always taught markets should be built so intelligent investors can make the right decision, not to protect dumb investors from making dumb decisions.
I think one of the things that I very much in agreement with, and I think is one of the shortcomings right now of current market structure, is we will repeal the prohibition against general solicitation and Reg D offerings, but we really haven't done anything to kind of standardize and require disclosure, if you will, to sort of foment an aftermarket in the Reg D private placement market. And so you're going to see, I think, that some of the aftermarket that the Second Markets and the SharesPost have been trying to develop would be greatly helped if people could agree as to information standards. And I know that you guys have done something in terms of allowing people to choose different kinds of tiers in your market so that they can broadcast to the market that they're living up to a higher standard, information standard. How has that worked for you?
Well, we've done, there's no structure, and it's been very frustrating in dealing with the SEC of going, okay, if a company's not SEC reporting, how do you get information to investors? And the SEC was like, well, we don't really want to give guidance. There's 144, there's 15C211, but they didn't really give good guidance. So we've tried to structure it, and we've done some cool things. In one way, we've created what I'd call SEC reporting light, which is a structure for disclosure that is comprehensive disclosure, in a non-complicated manner. And that came from our auditor, not me. But I like that line. But then what we do, what's really cool, is when you post a PDF of your disclosure on our website, we then, with Edgar Online, convert it to XBRL. So your balance sheet financial statements, now they show up on Yahoo Finance, they're going into investment databases. So we've created this structure for information to get into a database, to get in to be analyzed for non-SEC reporting companies. And if you look at what's kind of completely opposite of us to Second Markets is like, they play on that paranoia of Silicon Valley. Don't let anybody see your financials. Well, I have to tell you, you show on a computer screen your financials in a closed deal room, people take a picture with their iPhone. It is nothing. You know, you don't want anybody to know anything, don't tell them. Otherwise, if it's out there, it should travel. And that's our view is, these are just information problems. Markets function on information. How do you get the information out there? How do you get the fundamental information? And then how do you get the people, which is the brokerage industry, the financial advisors, the lawyers, the people who improve the quality of the indication of the information. They provide commenting on it, research. And research is, in my space, I see terrible research and I see great research. And it's, there's a wide spectrum. There's paid for research, which some is good, some is terrible. But research is, and there's basic research, and then there's very thoughtful, in-depth research. And all of those types of research is, what we haven't figured out a way, and I think it's a real struggle, is how do we get better research out there? Because it used to be, the quality of research, whatever we say about the Spitzer settlement, it didn't. To an institutional investor, the quality of research was protected by the sales force. When an institutional salesman went into an institution with an analyst and the research was crap, that institutional salesman didn't get many more orders if you were pulling out bad research. And that was the biggest police. And that was a market structure process. And how do we, if the institutional salesmen aren't taking small companies out, how do we create new processes? And that's a question. I think it's a real, how do we figure that out?
I have one more issue I wanted to get your fearless forecast on, totally shifting gears. Regulation A, how is it going to impact each of your businesses? We took the cap from 5 million to 50 million.
Well, it's not done yet. It's not out yet.
Well, no, and it isn't yet. It's got
270
270 days, I think, to promulgate the rules, and there's some question about whether or not there's going to be, is there a mechanism out there to get an exchange exemption from Blue Sky or not? Is there
We're talking about that in the hallway, before the panel.
Without tripping Form 10 disclosure and still providing some information light. And I'm sure there's been a lot of discussion. I know Cromwell, your guys are artful at dealing with the whole Blue Sky issue, whereas I think everybody else has probably, gotten a little rusty at that.
Reg A can be a game changer, because what you get is, it's a mini registration statement with the SEC, so it's reviewed by the SEC. That's going to be great for investor trust. It's going to require audited financials, which Reg A didn't before and Reg D doesn't. So that's going to be good. It is, you don't have to be SEC reporting, which is good, but it's immediately tradable, big plus, and so it should have a premium in there. And the SEC is going to start dealing with, and what's great is in the rulemaking, the SEC actually asked the law to give them the power to require that Reg A companies give them financial statements. So the SEC is going to start structuring disclosure for these companies, which is good to not be in SEC reporting. Now the pains are, it didn't get exempt from state Blue Sky, except for qualified buyers, and nobody knows what a qualified buyer is. And there is no time limit when the SEC can do the rulemaking. The states have actually said, we should change rules in all 52 venues before you do anything to Reg A, which is, that means we'll all be dead and gone by the time Reg A is done. But if Reg A works, and I'm very optimistic because we have almost 600 community banks on our platform that are traded, and they are not SEC reported. They report to their banking regulators, and Reg A is going to be perfect for them. And even if you have to do blue sky in the one state where you're located to get to your retail investors, and you can go to institutions across lines, this will be a great offering for them. And the most important piece of for SEC offerings is that legitimate companies are using it. Because if legitimate companies are using it, the banks will use it first, and then the biotech will use it. And then other companies will use it. And that will, Reg A is an unused offering right now. So it's not that functionally efficient, but raising it to 50 million, getting, and having a pool of, community banks are well banked. There's a lot of investment bankers who cover them, do capital raises. They'll be able to get a premium valuation when they do a capital raise to have it be tradable. And so I'm very bullish on Reg A if the regulators don't kill it.